Well, it usually through, Blackboard. I send it out through Blackboard. So it should automatically, right. No, I sent it, it should have posted yesterday, right? Yesterday morning. Yeah, the announcement. So how many people didn't receive an announcement? Okay. Okay. All right. Well, there's a quiz out there. I don't know why it didn't send a system announcement. That's what normally happens, and I select the button so that it would send you the announcement when it's ready. So I'll go in and double check. But most of you logged on and you saw that the quiz was there, right? Okay. It was, I postponed it. So it's due Monday morning. Okay? Okay, so we're going to talk about audit sampling. And in this section, I'm just going to give you an overview of audit sampling, what it means. We're not going to get into a lot of the detail in terms of how all of the different types of statistical sampling that can be done, the non-statistical sampling. I really want to distinguish between non-statistical sampling and statistical sampling. What you'll see is that the approach for both is the same. It's just that the method of conducting the sample is different, obviously, for statistical sampling versus non-statistical sampling. Also, this is, if you go into public accounting, all of the firms have their own sampling techniques. There are guidelines with respect to statistical sampling. There are requirements with respect to sampling and audit engagements. So you're going to get a lot more, if you go into public accounting, a lot more exposure to this based on the firm's methods. Okay, so this is just to introduce you to sampling and how it's used in the audit process. So if you recall from the opening scenario in the chapter, in the textbook, it gave a story of an auditor who was performing audit tests and performing a sample, selected a sample, and found a misstatement in the sample. And this auditor had a dilemma as to what they should do. What did the auditor ultimately decide to do? Good thing this is not a quiz. How many people have their books in front of them? How many people read the opening story in front of the chapters? They're there for a purpose. So what do you think that I mean by there's no such thing as an isolated misstatement? What does that mean to you? Well, yeah, because they're debits and credits, right? So it's going to be, but that's not exactly what it means, unless I'm misinterpreting. What do you, explain that a little bit more for me. So it's going to affect something else or multiple? Okay. Right, there's probability that there are others. And why is that a high probability? What are we doing here when we look at audit sampling? Well, we've assessed risk already, right? So this is a part of our audit procedure. Now we're testing. We've already assessed them. Right, we're collecting evidence, but if we find if we find a misstatement or an error in our sample, what does that tell us? Okay, so I think what you're trying to say is you have to project that misstatement to the rest of the population. The sample is just a representative, it's supposed to be a representative sample of your entire population. So therefore, if you find an error in your sample, you have to project that to the entire population. So in the opening scenario vignette, the auditor really didn't have a dilemma, right? Because the standards require you to project your misstatements to the entire population, right? You can't select, find an error, and then the client gives you some explanation and you go, oh, that sounds reasonable, right? Because this is supposed to be, so you can't say that the sample is representative only when everything is correct. And then when you find an error, well, it's not really representative, it's an isolated incident. Either you're making the decision that it's a representative sample and you can rely on the results. But if there are errors, you have to account for those errors. Okay? So, as I said, auditors are required to project to the entire population. So let's kind of look at where we have come from and where we are at this point. So if you remember when we talked about designing tests for controls and substantive tests, and that's what we're going to focus on with respect to audit sampling. And obviously this would impact the account balances, detailed testing as well. But focusing on controls and substantive testing, what we said the four-step approach is, one, apply the transaction-related audit objectives, and then identifying key controls and making some preliminary assessment about control risk. Based on those things, we then design the test of controls so that we can determine whether or not those controls are actually operating. Because we need to be able to support our control risk assessment, our preliminary control risk assessment, and then design substantive tests of transactions. And what's the relationship between controls, test of controls, and substantive tests of transactions? If we have highly effective controls, what are we going to do? What's the relationship between the test of controls and substantive test of transactions? So let's say we have a situation where we rely on internal controls. Controls are effective. Yes. Right. So if we determine that controls are effective, we've tested those controls, and we're satisfied that controls are working as intended, and we're satisfied that our initial risk assessment, control risk assessment was correct, then we could reduce the substantive test of transactions. So the more effective our internal controls and the results from our test of controls, the less substantive testing we would do. What we're trying to design here is, in designing the test of controls and the substantive test of transactions, remember there were 4 decisions that the auditor had to make, right? One, determine what the audit procedures are. The audit procedures are going to be driven by your transaction-related audit objectives. What are you trying to, if we're trying to attest occurrence, what would be an audit procedure, for example? If we're trying to test existence or completeness, what would be the audit procedure? So our audit procedures are going to be driven by these transaction-related audit objectives. We have to decide what items we're going to select to test, the sample size that we're going to select, and then when we're going to perform those procedures. So those are our 4 decisions. Just some definitions. Representative sampling or representative sample is basically saying that the sample accurately represents your population. That's all it's saying. It's accurately. So you want a representative sample. What happens if you don't have a representative sample? How does that impact the auditor's opinion or ability to test if they don't have a representative sample? Yes. Right. You can't give a fair assessment because you're not working with the entire population. So you can't make any conclusions if it's not representative. Right? If you don't have all of the sales or shipping documents in your population, then you can't make a conclusion based on your test. Right? So the auditor has to make sure that it's a representative sample. The way that an auditor does that is to make sure that they exercise due care when planning their sample procedures or sample selection procedures. So it's important. So think about some of the auditing procedures that you perform, reconciling the master file to the general ledger, ensuring that you have accounted for the numerical sequence of all of the shipping documents or all of the sales invoices. Part of those some objectives regarding those procedures are to ensure that you have a representative sample, that you are looking at the entire that you're working with or starting with the entire population. Sampling risk. Sampling risk, there are two types. There's sampling risk, there's non-sampling risk. So there's two types of risk associated with sampling, right? So sampling risk is that risk that's just inherent in the process of sampling. You're sampling, so therefore you're not looking at 100% of the items, so you have risk, right? Think about what we say in the auditor report, reasonable assurance. And we defined it, we said reasonable assurance exists, or auditors have to state reasonable assurance because they're not looking at 100% of the items. So there's no way that they could say with 100% certainty, right? Same thing. So there's just this inherent risk because you're sampling. And then non-sampling risk is really related to the auditor's judgment and the auditor's approach to the sampling. So it could result from the auditor's failure to recognize exceptions or inappropriate or ineffective audit procedures. So those are all driven by the auditor or auditor judgment. Right, so in the case of not being able to correctly identify an exception, that would be because the auditor really doesn't understand the nature of the account, or they don't really understand how the controls work. Right, so they don't have a complete understanding. So therefore, if they don't have a complete understanding, they won't know that they have an exception. Right. The way to minimize sampling risk would be to adjust your sample size, and then use appropriate methods to select your sample. So some of it's going to be driven by the company's systems, or some of it's going to be driven by the auditor's technology. But overall, the auditor has to have a really good understanding of the client's environment, the controls, the documents. So think about when we talked about the revenue process last week. One of the slides talked about the documents. First of all, understanding what the business functions are in each cycle, what documents and records are generated or created as a result of those business functions. That's why that's important, to have a complete, so you completely understand the process so that you understand what an exception is. And obviously to be able to design your audit test or your audit procedures. We're going to talk about both statistical and non-statistical sampling. Statistical sampling allows the auditor qualification of sampling risk in planning the sample and evaluating the results. Right? So statistical sampling, are you using statistical methods to sample? It's based on distributions. We're not going to get into the underlying different types of statistical sampling methods, but just to point out that there are more scientific ways of generating samples. Non-statistical sampling are those items that the auditor believes will provide the most useful information. Those are the ones that they select. So that's driven more by the auditor judgment. Right? So there's some inherent biases in non-statistical sampling. Right? There could be. Right? Because anytime you introduce judgment into the equation, you run the risk that there are biases. There's non-probabilistic sample selection and probabilistic sample selection. So non-probabilistic sample selection, basically the book talks about at least 3 different methods. So the directed sample selection is based on the auditor's judgment criteria. And what you realize with non-probabilistic sample selection, the auditor uses their professional judgment. And so here again is another instance of why it is so important to have a really thorough understanding of the client's business and the client's risk and the industry. So to really, you'll start to see where the upfront planning that the auditor does in understanding the client's business, why it's so critical, right? Similar to analytical procedures, your evaluation of the outcome of those analytical procedures is only as good as the input in terms of how you formed your expectations, right? If you have faulty expectations, you can't evaluate the outcome effectively, right? Same here, sample selection. If you don't know, when you're doing non-statistical sampling, if you don't have a good understanding of the client's business, the client's transactions, where the risk is, then you're not going to do a really good job in terms of selecting the items that should be included in your sample. Because in this case, we're introducing auditor judgment. So directed sample selection is based on the auditor's criteria using their judgment. It might be things such as items most likely to contain misstatements. Think about when we talked about the audit risk model, audit risk model. When we talked about preliminary planning, part of the process in the preliminary planning was analytical procedures, and we said the objective at that point was to identify a potential misstatement. Same here. So what accounts are likely to contain misstatements? Items containing selected population characteristics. So let's say, for example, there's a hive. You want to look at accounts receivable or sales in a particular business unit, right? Or sales to particular customers. So you're going to identify, the auditor identifies something about that population, right? And large dollar coverage, and that's what you see a lot of, large dollar coverage, right? And you'll see some combination of both of these, right, in terms of how the auditor makes their decision. So for example, they might say we're going to look at all items in this particular category or with these characteristics, and in addition, we're going to look at all accounts that's over a specified dollar amount. Haphazard sample selection, as it sounds, is the selection of items without any conscious bias on the part of the auditor. They just haphazardly select. So here's an example of a haphazard. When I was an auditor, way back in the day, we didn't use statistical sampling, at least not the audit staff, right? We didn't use statistical sampling. So our idea of a sample selection was to do some kind of random, flip a coin or take out a dollar, close your eyes, put your finger on the serial number, and whatever number that was you did every nth item. So let's say my finger happened to land on a 5. So I would start with the population and say, I'm going to select every 5th item. It was really haphazard selection. Clearly things are a lot better now, right? So that's haphazard. So there's no conscious bias because I closed my eyes, I took the dollar out of my pocketbook and put my finger down. I had no idea where it would land. And so it was clearly unconscious. No conscious bias on my part. Block sample selection is selection of several items in sequence. So the key here is the number of blocks you select, how many items in the block. Again, there's the element of judgment by the auditor, right? That's introduced. So those are your non-probabilistic sample selection procedures. Then you have probabilistic sample selection. And here's where you're getting to more statistical, right? So it's more scientific. It removes that judgment bias. So every item in the population has a probability of being selected. We're not getting into probability theory, but what you'll see here would be things like a random sample, right? And you can do random sampling using a random numbers table, or you can do computer generation of random numbers. So again, there's a much better way to select a sample than pulling $1 out of your pocketbook, closing your eyes, and putting your finger on the serial number, and whatever comes up is what you do. Systematic sampling is the auditor calculates an interval, and then based on that interval decides the sample size, right? Then probability proportional sample is, as it would suggest, the sample is taken where there's a probability of any item being selected from that population proportional to its recorded amount. So those are a little less haphazard than you would see with non-probabilistic sampling. The point of sampling is that you want to test for exceptions, right? So think about if you're testing internal controls. And you're testing internal controls over credit approval. An exception would be that a customer order was processed without the credit manager's approval. If the control is that all customer orders have to be approved by the credit manager before processing. So you're testing for exceptions. Another example would be the auditor determines that the exception rate for internal verification of sales invoices is approximately 3%. So basically what you're doing is you're setting based on, and this is going to be based on the auditor's judgment, based on the auditor's prior knowledge of the client or audit results from the past, if it's a continuing client, the auditor is expecting that there's a 3% rate indicating that there's 3 out of every 100 invoices will not be properly verified. So they're setting what they believe the tolerable exception rate will be. The types of exceptions in accounting data would be, as I pointed out, deviations from clients' established controls. Right? Monetary misstatements in the population of transaction data, or monetary misstatements in the population of account balances. So again, remember, with respect to controls and substantive tests of transactions, we're looking at the first two, right? You're trying to determine whether or not there are any exceptions to control procedures or any exceptions in monetary amounts. So we're testing for exceptions when we're doing sampling. The sampling approach, as I pointed out, is going to be the same whether it's statistical sampling or non-statistical sampling. The difference is, as we saw with non-statistical sampling, there is more judgment involved in that process. It's not scientific as what you would have with a statistical sampling. So we're going to first focus on the first part of the approach, which is planning the sample. So the first thing you have to do is state the objectives of the audit test, right? Because that's how you're going to be able to identify what an exception is. So for example, testing the operating effectiveness of internal controls. So regardless of what controls you're testing, you're trying to determine whether or not they're operating as intended. Right? So whatever cycle you're in, if you're testing controls, that's what your objective is. Are controls operating as intended? Then decide whether or not audit sampling applies. So when would audit sampling, think of a procedure, an audit procedure, in the sales cycle, revenue cycle, when wouldn't you be able to use audit sampling? What kind of audit procedure must we perform, but it's not subject to sampling? Not an assertion, an audit procedure, because occurrence is you can use sampling. You are going. So think about the test that you're using for occurrence. How would you test occurrence? Right. So you would use sampling then. Right. So you would use sampling though, right? But what other procedures do you have to perform if you're auditing sales that you would not be able to use sampling? So as a hint, let's look. you turn to your textbook and look at Table 14.2, Audit Procedures for Hillsburg Hardware Company. Everybody there? So, given those audit procedures, which of those audit procedures would sampling not be relevant? It's not a trick question. Okay, let's flip it. Which of these audit procedures would you use sampling? Be more specific. So you would trace back, you're tracing sales to shipping. Okay, what are you tracing? Right, but when I say you have to select, if you're going to use sampling, you have to select a sample of what? To be able to do that. What are you selecting a sample from, right? I'm sorry? Right. So you can select a sample of invoices. You can select a sample of shipping documents. So you can use sampling, right? You have an entire population of shipping documents. So for occurrence, right? Occurrence says that for every item that's recorded in our sales journal, it's a valid there was a valid shipment. So the test that we're going to perform is to select a sample of shipping documents, right? And tie those, we're going to select those transactions and trace them to the shipping document, right? We're going to select duplicate invoices from their sales journal and trace those to shipping documents, right? So for you to be able to perform sampling, you have to have a population of something to be able to sample from. Analytical. Exactly. Right. Analytical procedures, you're not going to do sampling on, right? In order to do sampling, you have to be able to sample. So other procedures like reviewing the journals and the master file, you're not going to sample which journal and master file you're going to review, right? You have to review the sales journal. You want to reconcile the sale, make sure that the sales journal has been reconciled to the general ledger, right? So those are not audit procedures that lend themselves to sampling. And so the important thing, that's why it's important to decide which of your, not all of your audit procedures are going to lend themselves to sampling. So you have to be able to identify which of those audit procedures can you use audit sampling for. Then once you've decided whether or not audit sampling applies, so let's say you're testing occurrence, you know that you can use sampling procedures to test the occurrence, right? Assertion. Define your attributes and the exception conditions. So what are your attributes? Your attributes are going to be those things that you're trying to test. So if you take a look at table 14.3, attributes defined is the name of the table. Attributes defined, test of Hillsburg hardware billing function. So this is an example of the attributes related to the billing function for Hillsburg hardware. Right? So an attribute would be the existence of sales invoice number in the sales journal. That's what you're testing. You're defining that. And that is tied to procedure number 12, okay, which is table 15.2. Procedure 12 says, account for sequence of sales invoices in the sales journal. The attribute related to that is the existence of the sales invoice number in the sales journal. You see the relationship? So an attribute is not the procedure. The attribute is what you're testing. The procedure is telling you that the audit procedure you have to perform is to account for a sequence of sales invoices in the sales journal. What you're testing to make sure is that it exists, that invoice number exists in the sales journal. What you're looking for in terms of your exception is that if you found no record of the sales invoice number in the sales journal, that would be considered an exception. So again, it's important you have to define what your attributes are, which are related to your audit procedures, because remember, your sampling is your audit procedures. It's the performance of your audit procedures. You have to be able to define what the attributes are and identify what the exception conditions are. Another example of that would be attribute number 4 on table 15.3. Evidence that pricing, extensions, and footings are checked. Right? That's related to procedure 13B. Trace selected invoice numbers from the sales journal to duplicate sales invoice and check for the total amount recorded in the journal, date, customer name, so forth and so on. Right? The exception then would be if there is a lack of initials indicating that it has been properly verified. So once you've decided whether or not it's subjected to audit sampling or lends itself to audit sampling, you've defined what the attributes are and the exceptions, that was it, what would be considered an exception if those attributes are not met, right? Again, your attributes are linked to your audit procedures. Your audit procedures are what you are to examine, to collect evidence on, and you are defining what the attributes of that evidence collection is. Okay, define the population, and that's important. Why? Because we need a representative sample. So completeness is extremely important. You have to know that you have the entire population because you want to draw a representative sample. Okay. Once you've defined your population, then define the sampling unit. And that has to be consistent with your audit objective. Think about your transaction-related audit objective. So the sampling unit has to be consistent with that. So if you take a look on table 15.2, right? I'm sorry, 14.2. If you look at 14.2, this tells you what your audit procedures are. Okay? So what you're trying to test, for example, then, would be looking at 12 through 14. So just look through 12 through 14 for the billing of customers and recording of sales in the records, right? So if you're testing for occurrence, right, of recorded sales, for example, your sampling unit is going to be duplicate sales invoices. Right? That's what, if you're testing for occurrence, you want to ensure that all sales that are recorded in the sales journal are for valid sales that actually occurred. So you're going from the sales journal to the shipping documentation, to the support. That's the direction you're going in. So your sampling unit then would be a sample of sales or duplicate sales invoices. The reason they're duplicate sales invoices, right, is because you sent the original sales invoice to the client, to the customer. So you're going to select a sample of duplicate sales invoices and trace those or tie those to the appropriate sales documentation, related shipping documentation, sorry. What would be your sampling unit if you're testing completeness? Right. So your audit procedure is to verify that the shipping, that for all sales, for all valid sales, okay, that they've been reflected in the financial statements or in the sales journal, right? So that's completeness. That's to ensure we know that it occurred, so now let's make sure that it's been recorded. If shipping documents trigger revenue recognition, then we're going to go, for completeness, we're going to go from the shipping documents and back to the sales journal. So the sampling unit in that case would be the shipping document. Do you see why it's important to understand your transaction-related objectives? Because if you don't understand your transaction-related objectives, you're not going to select the right sampling unit. Right. So define your sampling unit, specify what the tolerable exception rate is. So remember on the previous side, the auditor had some expectations about what the tolerable exception rate is. In the previous example, it was 3%. Okay. The auditor specifies that is based on auditor judgment, just as the acceptable risk of assessing control risk too low, the estimate of the population exception rate, right? That is going to be based on the auditor judgment. So let's take a look at some of the definitions of these terms that you're going to use or see. The attribute is the characteristic being tested. The acceptable risk of assessing internal control risk or assessing control risk too low, again, is what the auditor is willing to accept, what risk the auditor is willing to accept. Remember, we talked about the audit risk model. We said the audit risk model, the auditor is willing to accept some level of risk that they issue an incorrect opinion, right? That they say that the financial statements are free of material misstatements when indeed it's not. And obviously they want to keep that risk low. This is similar in that the auditor is willing to accept some risk that they say that a control is effective and that control is not. Again, just as audit risk is the auditor's judgment, acceptable audit risk is the auditor's judgment, this is the auditor's judgment in terms of what they're willing to accept. So that's the auditor's measure of sampling risk. Remember when we talked about risk, we said there's some risk in sampling just inherent in sampling because you're performing sampling. The tolerable exception rate is the exception rate that the auditors will permit in the population and still be willing to conclude that the control is operating effectively if we're testing controls, or that the amount of monetary misstatement in the transactions is acceptable if we're talking about substantive tested transactions. So this is, think about materiality, right? The difference here, materiality, we said, is a quantitative measurement of a misstatement that can occur and not affect the judgment of a rational user, right? So basically, it's the financial statements can be incorrect by this amount, and we can still conclude that the financial statements are fairly misstated. That's basically what materiality says. This tolerable exception rate is kind of saying the same thing. We're willing to accept this error or exception rate in the test of controls or the substantive test of transactions and still conclude that everything is operating correctly. or the amounts are fine, they're acceptable. Then the estimated population exception rate is what the auditor expects to find in the population before testing begins. That's kind of what they expect to find, based on prior history of the client, based on their understanding of the client's control environment, again, judgment. And the initial sample size is determined after considering all of these factors. And we'll go through a couple of examples on how to determine that. As I pointed out, the acceptable risk of assessing internal or assessing control risk too low, or the tolerable exception rate, these are all auditor judgments. There's some guidelines, and these are some of the guidelines. But what's important to remember, especially those of you who are going into public accounting, firms are going to have their own guidelines, right? And that's what you're going to abide by on all of your audits, are firm-established guidelines. But just for our purposes as we're going through this, here's some general guidelines that have been used with respect to testing controls. The auditors have to consider various factors, right? And when you're talking about internal controls, one of the factors is that the auditor is required for publicly held companies to issue a statement or report and an opinion on the effectiveness of the client's internal controls, right? So they have to consider that, in other words, this is going to a third party, right? The public, if it's a publicly held company, gets this report. They're going to rely on this report, quite possibly, right? So they have to consider that. The nature and extent and timing of substantive tests, and also the quality of the evidence that's available. Those are some examples. And then the significance of the transactions and the related account balances. So if the auditor's judgment is lowest assessed control risk, so basically they have assessed control risk is very low, then the auditor's acceptable risk of assessing control risk too low is going to be low, right? Moderate, you'll see medium ACR. Higher, then you'll see high ARCR, right? If you have 100% control risk, meaning you can't rely on the controls, and this is not possible, right? Then you're not going to have any acceptable risk, because you know you can't rely on internal control. In terms of the significance of the transactions and the related account balances that the internal controls could affect or intended to affect, you have to look at whether or not the auditor's judgment would be, is it a highly significant balance? If it's a highly significant balance, then their tolerable exception rate is going to be 4% as a guideline. If it's a significant balance, then 5%. If it's less than significant balances, if the balances are not significant, then it's 6%. Okay. So I just want to reiterate that these are guidelines that might be very well be different in practice with whatever firm that you go to. With respect to substantive tested transactions, what the auditor is looking at, whether or not their planned reduction in substantive tested or detailed balances, is it a large planned reduction? So if it's a large planned reduction, really your internal controls, your understanding of and test of controls should be excellent, right? Because what did we say? If we find controls to be highly effective, we assess it as highly effective, our testing indicates that it's highly effective, then we can reduce the amount of substantive tests, the transactions, right? So if it's excellent, then your assessed risk, acceptable risk, blah, 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 for substantive tested transactions is going to high, and it's really going to be driven by your tolerable exception rate is going to be driven by your materiality, right, that you've established in your planning phase. If it's moderate, you can see the impact. If it's excellent, then it's high. If it's good, then it's medium. If it's not good, then it's medium to low. So it's really you're going to assess this by looking at how much am I planning on reducing my substantive tests, and what are the results of my internal control testing and the impact of that. And how does that affect my assessed risk, my acceptable risk of assessing control risk too low? Okay. I want to take a look at, let's take a look at problem 1428 in the text, and let's walk through. So just take about 10 minutes in your group and work through 1528, but just focus on part A of 1528. I don't have the custom book, so I'm not sure what page it's on. Can somebody tell me what page it's on? Let's see. 495? Okay. So if you don't have a text, please sit with someone, because I want everyone to work on this problem. Yep. Yeah. So basically what this problem is, you have 7 scenarios. They tell you for the first column, assume the sample size is 90. So what you want to do is look at how these various factors, right, auditors' acceptable risk of assessing control risk too low, the tolerable exception rate, and the expected estimated exception rate, right? And look how that changes, and look at how those changes, these 3 factors changes, and assess for columns 2 through 7 how that would impact the sample size. Okay, so you are starting with assuming that column 1, the sample size is 90. And how does the changes in these 3 factors affect the sample size? No, you can sit with, just as long as you're sitting next to someone who has a textbook. So these are some guidelines. Okay. have a lot of stuff we work on together.
I've read a couple like for other paper solutions.
Yeah.
And you worked with him when you were in Boston?
Yeah. Yeah. He was at BC one time. I went there.
When Mr. said that I have a candidate for you, what does he mean by that?
He said that to Audit?
Yeah. Meant me.
He meant you?
Yeah.
Oh, good.
He mean for the job?
Probably.
Is it because the environment there?
Yeah, yeah. It's a nice group there.
Nice group.
Yeah. I have, like I know Ernest in there, we worked on a project with Big Nash, she's there. And then I have a good friend, Cynthia Jackson, who's there. They have a nice group. They have a nice group. I interviewed them, but they didn't make me an offer.
They didn't make you what?
They didn't make me an offer. Yeah.
They can delete it.
Okay, so let's take a look and go through the remaining 6 characteristics. So again, what the problem asked you to do was assume that you're starting with a sample of 90 and then basically analyze the changes in these 3 factors to determine whether or not how your sample size would increase or decrease based on changes in these various factors. So let's take a look at number 2, right? So what is the impact on your sample size and why? So it increases, and why? Right, it goes from 10 to 5. Okay. What about number 3? Oh, you were doing, well, I thought you were doing number 2. Right? Right, you were doing number 2, right? Because so number 3, you said it increases, right? For what reason? Okay. Right. 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 So if you look at table 3, right, your sample size go up. You can also compare column 3 to column 2. So if you compare column 3 to column 2, you see that there's no change in the acceptable risk of assessing control risk too low, right? It's both 5. But what changes there is your tolerable exception rate. So again, your sample size would increase. What about number 4? Column 4. Why do you think it'll decrease? Well, if you compare 4, right, but 4 is the same as column 2, right? And we said that column 2 increased. So what's different between column 4 and column 2 that would cause you to? But remember, as the population size increases, the required sample size is normally unchanged or may increase slightly, right? So in other words, the population size has little to do with it. You're going to really focus on the auditor's acceptable risk of assessing control risk too low, their tolerable exception rate, and the expected or the estimated population error rate. TER increased, the sample size should increase, right? But TER didn't. If you look at it compared to, so if you look at column 4, right? Column 4 is exactly the same as column 2. Right? The only difference is the population. That's the only difference. So if column 2 you said increase, why would column 4 be decrease? It's the exact same thing. The only change is the population size. That's kind of what that is getting to. That example is getting to. The population size is not going to drive that. Okay? All right. What about column 5? Column 5? Decrease? So does everyone agree with that decrease? Why? Why did you conclude that? Right. 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 So if you think about it, the key there is right. If you compare column 5 to column 1, it's the acceptable risk of assessing control risk too low is unchanged. However, if you look at tolerable exception rate, right, or that's 20%. So if we go back to this guideline, right, right? The guideline is that less significant balances, the tolerable exception rate of 6%, right? So if it's 20%, that should indicate, if the auditor set at a tolerable exception rate of 20%, that should suggest to you that the account is not significant. If the account is not significant, why would you expend a lot of resources testing the account, right? So you wouldn't increase the sample size for an account that's not significant. You set your tolerable exception rate. So you're willing to tolerate a greater exception rate, but the account is not significant, so the likelihood of it having a significant impact on the financial statements are really, really low, right? So why would you increase the sample size? So that's the rationale behind column 5.
So you're willing to change the sample size because even though it says 20% overhead, you should go with the 6%?
Well, but this says, let's go back, but 6%, right? They're accepting a higher, so 6% is usually if it's not a significant balance. It's less than significant, meaning the balance is just not that important, right? It's not going to have a significant impact on the financial statements, material impact. So if this, and remember, these are guidelines, okay? So in this example in the textbook for column 5, the auditors set this at 20%. So if 6% is our guideline for not significant, then I think that says something about 20. If they set a tolerable exception rate of 20%, they're willing to, the account can't be significant. So you wouldn't increase your testing then. Because basically if you increase your sample size, by increasing your sample size, you're looking at more items. If you determine that this account is not that significant, whatever reason the auditor is testing it, they're testing it. But it's not significant. What the auditor is concluding with that exception rate is that any errors we find, they're just not going to have a material impact on the financial statement. So it's not going to rise to the level of being materially misstated. Right? So if, in that case, why would you look at increase your sample size for an account that you have decided won't have a material impact on the financial statement? Does that make sense? Make sense, everyone? Okay. All right. What about 6? Right. Same thing, right? The tolerable sample size is actually, it's the exact same thing, right? The sample size is just smaller. Okay. And then finally 7. I hear decrease, increase, which one? Increase, right? Why is that? Okay. Okay. But remember, the population size is not going to necessarily what drives it, but you would increase your sample size. And here, what you could look at also is compare column 7 to column 3, for example. Right? If you compare it to 3 or even 4, what you're seeing is a change in the tolerable exception rate and also the expected population error rate. So for number 7, you would increase your sample size. Okay? Any questions on this? I wanted to point out so that you could kind of think through, just similar to what we did with the audit risk model, think through the impact of changes in the components of the auditor's judgment, okay, that would impact the auditor's final decision in terms of the, the sample size. So it's giving you some level of intuition about how these factors impact your sample size. So now what I want you to do is go to B, Part B, and using the tables and these factors as they are in columns 1 through 7, identify what the sample size will be. So the first part of it, you just used intuition and said it would increase or decrease. Now I want you to come up with the sample size based on the table. Does everyone see the table? It's table 14.8. I'm not sure what page it is on your, I'm sorry, 486. Okay? So what you see is a table so that you can determine the sample size. In that table, you have the assessed risk, acceptable risk of assessing control risk too low at the 5% rate, and the bottom half of the table is the 10% rate. Along the sides, you have the estimated population exception rate, and along the top, you have the tolerable exception rate. Okay? And those are the three factors that you're going to use to determine the sample size for 1 through 7. You have the textbook, the same? It's 15.8. Yeah, table 15.8. Is everyone able to figure out how to select the sample size using the table? No? Yes? Okay, I'm coming over.
So let's say you have a 4% PER, that would be 74, right?
Well, 4%, and then what's your expected population, right?
Oh.
So if it's 0, let's say it was 0, and the acceptable risk of assessing control risk was at the 5%, right? And then it would be 74. If it's your tolerable exception rate was 4%, your estimated population exception rate was 0, and this was, okay? Okay. So let's take number 1 for example, right?
Right, so 10.
So you're down here at this table.
Yeah.
What's your tolerable exception rate? 6. Right? 6. So you go across top. So you're going to be down here. And what's your expected?
2.
And then so 2.
Oh. I didn't think it was that easy.
It's amazingly easy. Yep, that's your sample size. Okay, so here we are. Let's walk through it. So let's take number 1. So you're going to be looking at this bottom half of the table. What's your tolerable exception rate? 6%? So that means you're going to come down here, 6%, and then what's your exception? 2. And so that gives you 288. So that's your sample size. You guys figure it out? It's just blowing your mind because it's so easy, right? It's like it couldn't possibly be this easy. Yeah, you're doubting yourself. Think about that, right? You're at the 10% level, right? So this is the first one, right? So you're going to come down to this second half, bottom half of the table. Your tolerable, right, so you're at the 10%. Your tolerable exception rate is 6%, so you're going to be in this column. And then go down to your expected exception rate, estimated exception rate is 2. So 88.
Oh.
Didn't I tell you? You probably looked at 88 how many times and say, it's not that easy.
We were looking at the 10. We were looking at like a 10.
Oh, no. Yeah, become the 10, and then yeah.
Oh, I get it. Okay.
Okay. You guys figure it out? Are you good? You guys are good?
Yeah. How's 60?
Why are you all over at 42? Oh, okay, over there. Okay, you guys are good. You got it. You got it? Okay. Everyone got it? It's ridiculously easy. So obviously it won't be an exam question. Okay. So everyone had a chance to at least try to go through a couple of them, right? So what did you come up with for, of course everyone came up with 88, right? For column 1. What about column 2? Column 2. 127. 127, everybody came up 127. What about number 3? 181. Number 4. Number 5. No, you're not. The population size, remember, doesn't matter. Right, what you're looking at is your acceptable risk of assessing control risk. So you're going to look at either the top half of the table if it's 5%, or the bottom half if it's 10%. Right, it doesn't matter. There's nothing in there. Remember, that's why we said the population size really doesn't matter. So if you look at the table, we'll switch to your table.
Yeah,
right?
We found the numbers of
Right. So that the only factors are these.
EPER.
Right. So that's why we're saying. So if you think about it, when you just looked at the changes in those factors, right? You were on target in terms of how your sample size would change. So when you go to the table and actually plug those factors in, you could see the movement in the sample size based on the change if you track it back, right? So we said that, for example, in column 2, we said that the sample size would increase over column 1. And you see that. In column 1, the sample size is 88. In column 2, it's 127. We see an even bigger increase over column 2 and column 3, right? Column 3 is 181. Then I think we said for 5 that the sample size would decrease. And if you look at it for 5, you would only select a sample of 25, right? So again, it's just to highlight that it's the auditor's judgment, and that's why the auditor's judgment is so important, because these 3 items, right? These 3 items are based on the auditor's assessment, and it's based on auditor's judgment, which is going to impact sample size. And your sample size, right, is what we use when we're selecting our sample. So we're going to select a sample. So for example, the second phase of our sampling approach is to select a sample and perform the audit procedures. So this is your evidence collection at this point, right? This is your evidence collection. So if you're testing the occurrence, right? If you're testing occurrence for sales, what you're going to do is you're going to define your sampling units, right, as duplicate sales invoices, and an exception would be that there's no shipping document to support those sales invoices, right? So, and you've defined your population, you've set your tolerable estimate, your tolerable exception rate, your acceptable risk, your estimate of the exception rate, and you're going to select 25, let's say if it was column number 5. You're going to select 25 duplicate sales invoices, and you're going to test that. If these judgments are off and they're not based on a well-developed understanding of the client's controls, the client's system, business, the client risk, then this means you're going to underperform. You're going to either select too much or too little, right? And so you're not going to, your audit procedures are going to be faulty. So remember we talked about in one of the previous slides how important it is for the auditor to have appropriate and effective audit procedures and be able to understand what and recognize what exceptions are and what they mean, because that has an impact, because this is the evidence collection process. You're basically determining the amount of evidence you're going to look at and selecting your sample size. So once the auditor determines the sample size, they select a sample of items based on what the sampling unit is, and then they perform their audit procedures. So trace a sample of duplicate invoices to shipping documents. Select a sample of shipping documents, trace it back to duplicate invoices, right? Depending on what the transaction-related audit objective is. And then once you've completed your testing, you're going to evaluate the results and generalize from the sample to the population. So then we opened this lecture, I said there's no such thing as an isolated misstatement. Auditors have to generalize or extrapolate the errors that they find or exceptions that they find in their sample back to the entire population. So let's look at an example of that. If you turn to figure 14.2, which is the sampling data sheet. Did someone tell me what page that's on? 472. Figure 14.2 on 472. Right. Now, this is what you're going to be doing for the Pinnacle case, right? So what you see is that the data sampling sheet or sampling data sheet this is a work paper, so this would be in your work paper to document the testing that you perform, your approach to testing controls and substantive tests, the transactions. You'll see that it lists the client, what the audit area is, the date, the year end, what the population size is, so they note what the population size is on the work paper, define what the objective is. And in this case, the objective is examine duplicate sales invoices and related documents to determine whether the system has functioned as intended and as described in the audit program. They define the population precisely. This case is sales invoices for the period 1/11 to 10/31/11. The first invoice number, what that is, and then the last invoice number. So they're defining the sequence. And they then define the sampling unit, which in this case is sales invoice number. The organization of the population is recorded in the sales journal sequentially. And the random selection procedures, in this case, they're using computer generation of random numbers. So this is all documented in your work paper. So then you'll see at the bottom, it's a description of the attributes. And if you look at the description of the attributes, they tie back to the audit program. So you'll see audit procedure 12, procedure 13A, and so forth. So they tie back to the audit program. And then it's the auditor's assessment of the acceptable risk of assessing control risk too low, the tolerable exception rate, and then the estimate of the population exception rate, which the auditor lists. So now what you're seeing on this table, though, is instead of numbers for acceptable risk of assessing control risk low is low, high, medium. So, and that is quite possible you'll see that out on your audits, or you'll see numbers as we saw in the previous example, right? Usually if it's statistical sampling, they'll use numbers, and if it's non-statistical sampling, they'll use high, medium, low. In this case, they're using high, medium, or low, and then you'll see the initial sample size. So instead of that table that we saw, you would see high, medium, or low. That's it. But it's the same approach of considering the tolerable exception rate, acceptable risk of assessing controls too low, and the exception rate, right? Estimated exception rate is what drives your sample size. And so that would be documenting the sample selection procedures. And then if you turn the page and look at figure 14-4, which is about 3 or 4 pages later, 478. So take a figure 14-4 on 478. Again, it's the sampling data sheet, but now the tests have been performed, right? They've selected the sample, performed the audit procedures, and now what this table is doing is evaluating the results. So it's identifying what the results are of testing each of these attributes. And so if you look, for example, for the first attribute, the sample size was 75. That was the initial sample size. It remained unchanged, 75. There were no exceptions. Right? So for there was for the invoice, the duplicate invoices were in the sales journal. There were no exceptions, right? So the sample exception rate is 0, and the calculated sampling error is 4.0, which is just different. Basically, the tolerable exception rate minus the sample exception rate. So, okay. So if there were no errors, so it's 4. And you do that for each attribute. So you can see, for example, you have, if you look at 4, attribute 4, right? There were 10 exceptions out of a sample of 100. There were 10 exceptions. So the sample exception rate is 10. And that exceeds the TER, right? That exceeds the tolerable exception rate, because the tolerable exception rate is 5. The sampling exception rate is 10. That's problematic. You see that also for attribute number 9, that the credit is approved. Again, the number of exceptions were 12, and the sample size is 50. So this sample exception rate is 24. Again, it exceeds the tolerable exception rate of 9, right? So that's significant. So you'll also see at the bottom of this, because this is evaluating the results, analyze, and then go on to analyzing the exception, So you'll see at the bottom, it gives you the intended use of sampling results, the effect that it has on the audit plan. And so for those attributes where there were exceptions, they've identified 2, 4, 5, and 8. 2, 4, 5, and 8, okay, as being requiring additional follow-up procedures. So they're going to do additional emphasis is needed in confirmation, allowance for uncollectible accounts, cutoff tests, and price tests for the financial statement audit due to the results of tests for the attributes 2, 4, 5, and 8. So for 2, 4, 5, and 8, because the sample exception rate exceeded or was equal to the tolerable exception rate, the auditor's decision process is to do additional testing. Put emphasis on that testing. You'll also see the effect on the report on internal controls. because the auditor also reports on internal controls. This is a publicly held company, and they talk about the allowance for sampling error is too small, or the standard, the sample exception rate exceeds the tolerable exception rate for 2, 4, 5, and 8. They've communicated it to management to allow them an opportunity to correct the control deficiency to be made by year end, right? Because if you're doing, remember, part of our audit process is the timing of procedures. So if they correct it before year end, right, the auditor takes that into consideration. If timely correction is made by management, the corrected controls will be tested before year end for purposes of reporting on internal controls over financial reporting. Okay. And then at the bottom they have recommendations to management. So that would be, again, this is what goes in your work paper to document the results of your testing. You also would, because you had exceptions, the auditor has to analyze the exceptions. So if you look at the following page, figure 15.5, right? Figure 15.5, it is an analysis of the exceptions for those attributes 2, 4, 5, 6, and 8. Okay, where there were exceptions. You see the number of exceptions. It explains the nature of the exceptions, and then what effect those exceptions have on the financial statement audit, and whatever other comments the auditor has related to that. So you can see for the first attribute, they're going to have additional substantive work is needed, perform expanded confirmation procedures, and review older uncollectible account balances. Okay. So with a concern, if you look at attribute 2 says the amount and other data in the master file agrees with the sales journal entry. So basically they found inaccuracies or exceptions in the amounts the information that was included in the master file. Okay, so if you relate that to Audit Procedure 13A, Audit Procedure 13A says, trace the selected sales invoice numbers from the sales journal to the accounts receivable master file and test for amount, date, and invoice number. Right? So this is where you're testing the information contained in the accounts receivable master file, which is why, in terms of analyzing the exceptions, they're going to expand the testing on confirmations and the allowance for doubtful accounts, because the impact to the financial statements is on accounts receivable, is in accounts receivable. Okay. So that was the analysis of the exception, and then the auditor has to decide the acceptability of these results. Okay. Questions? Don't ask me about that exam. Like, you really think I have decided the exam? Now, if I told you yes and then put it on there, you just kind of fret, right? So could we talk about the exam as we get closer? Okay. All right. So the types of things, when the auditor determines that the population is not acceptable. Let's back up for a minute, because I want to. What you're doing is you selected the sample size. I don't want you to just think intuitively about it, okay? Don't get all caught up in the steps. Don't try memorizing the steps. Think intuitively what you've just done. Let's go back here, right? Okay, these are all judgments that the auditor makes. You understand you have to have audit procedures. All you're doing is selecting the number of items you want to look at to perform these audit procedures, right? That's what you're doing intuitively. That's what you're doing. You're performing your audit procedures. This is all just coming up with a statistical or non-statistical way of determining the sample size. What number do I want to look at? What's the optimal or best number given all of these judgments that I've made as an auditor in terms of selecting the number of items that I look at? that I perform these audit procedures on that's in my audit program. That's all. You perform, you're collecting evidence. This is your evidence collecting phase. You're performing your audit procedures. Once you perform audit procedures, you're analyzing the results of your audit procedures. That's what you're doing. Intuitively, I performed the test, now I'm analyzing the results. That's it. Right? So don't get over like, ooh, it's like 14 steps. Right? It is 14 steps, but it's 14 steps because we're being very detailed in terms of the things that the auditor has to consider. Right? Okay. All right. So when the auditor determines that the population is not acceptable, they could revise their tolerable exception rate or their acceptable risk of assessing internal controls too low, but that's not really something that the auditor would really want to do, but they can. It isn't an alternative, but it should only be followed when the auditor determines that perhaps they were too conservative, or maybe they didn't have a good understanding of it. They can also expand their sample size and increase their testing because that has the effect of decreasing your sampling error if your sample exception rate does not increase. Or you could revise, as an auditor, the excess control risk. And this, again, is auditor judgment in terms of how they respond to exceptions that they find to determine whether or not the population is not acceptable. But again, in all cases, you're going to communicate with management and the audit committee, and we just went through figures 14.4 and 14.5 to see how the auditors in the example in the textbook addressed those exceptions that they found, and you saw that they expanded their audit procedures. Just to talk a bit about statistical audit sampling. Usually when we talk about statistical audit sampling, what you'll see is attribute sampling. That's probably the most common. And again, this is just, you know, as I want to qualify to say that firms, you know, you could have two different firms doing two different approaches. So it's really going to be driven by what your firm, what statistical sampling packages your firm uses. But attribute sampling is one that you do see a lot. It uses the table to determine the sample size, and that's what you did. The population size is a minor consideration in determining the sample size. We saw that when we went through problem 1428. The representativeness of the sample, because remember we said it's important to have a representative sample, that is your sample is representative of your population, is ensured more by the selection process than it is by the sample size, right? In terms of the population. Perform your audit procedures and then evaluate your results. So the takeaway here is statistical sampling is based on distributions. We're not going to get into all of that. It's just to know that it's a more scientific way of selecting your sample size. It removes a lot of the biases or judgments that are involved in non-statistical sampling. However, the approach is the same. It's the same approach. You're still going to go through the same thing. You have to define your sampling unit, right? Understand what an exception is. You're still doing those things because you still have to perform your audit procedures and evaluate your results. Questions? Okay, no questions then. So let's go through So we're going to just go through an overview of the acquisitions and payment cycle. And so the acquisition and payment cycle really is a mirror image of the revenue cycle, right? So And as I pointed out before, the audit approach is the same approach. It doesn't matter what the cycle is. It's just the documents that we're going to look at, the journals that we're going to look at are going to be different, but the audit approach is exactly the same. So here you're looking at accounts related to cash disbursements, accounts payable, so controls and substantive tests related to those. The important thing, again, is understanding what the major business functions are in any cycle that you're auditing. Because if you understand the major business functions, you understand what the transactions will be in those functions, and then what documents are generated as a result of transactions in those functions, and what journals are impacted and where they appear in the financial statement. So you have purchasing, processing of purchase orders, receipt of goods and services, which then recognizes your liability, accounts payable, and then you process and record the cash disbursements to satisfy the liability when you pay it. Right? So those are your major functions in that cycle. The balance sheet accounts and the income statement accounts, so obviously we're talking about payments. So things you'll expect to see would be things like income tax payable. Obviously, accounts payable is probably the biggest balance sheet related item, and inventory if it's a manufacturing concern. Insurance, expired insurance or prepaid insurance. Furniture and equipment, cash, accumulated depreciation related to furniture and equipment, property taxes payable, and then on the income statement side, expense accounts such as income tax, advertising, travel, cost of goods sold, property tax, depreciation, rent expense. So those are the payables and expense related accounts that you would expect to see as a result of the acquisition and payment cycle. In terms of the documents and the records in those cycles, you have the purchase requisition. And what the purchase requisition is, you may or may not see purchase requisitions in an organization. It depends on the organization, their organizational structure. But a purchase requisition is usually generated internal, like the purchase order is generated internally. But what it is, it usually comes from user departments. So let's say, for example, I'm a user department, I'm in the finance department, and I need to order office supplies. So I would issue a purchase requisition to the purchasing department to place an order with whatever vendor we use, or vendors, if we're going to do competitive bidding, to order those office supplies. So if a company has that level of control and they have purchase requisitions, they become important to the process because they commit the company, in the sense that a purchase order is usually sent to a vendor to solicit purchase of those goods. So you don't always see purchase requisitions, but they are, in certain organizations you will, especially in manufacturing companies that are manufacturers. You see purchase requisitions quite a bit. The purchase order is what the company sends to the vendor, and in a sense, it becomes a contract between when the vendor fills that purchase order. You're asking the vendor to sell you goods. The receiving report is like the shipping document, is important to the revenue process. The receiving report is important in this process because it's what initiates the liability, right? When we receive the goods, we record a liability associated with the receipt of those goods. And then the vendor's invoice, and obviously the check for the disbursement. The records would be the accounts payable master file, the cash disbursements master file, and then the transaction-related files such as the acquisitions journal would be an example of a transaction file. Okay. Functions of the purchasing process I went through. I talked about the requisitioning, which is the initiation and approval of requests for goods. The purchasing department issues and approves the purchase orders and ensures that there's proper price in accordance with the company's guidelines, the quantity, the quality of the goods, the vendor. What you see in terms of internal controls over purchasing is some companies will have a rotation of purchasing agents, right? So that you don't have one purchasing agent making all purchases from one particular vendor, so you rotate that, so you try to avoid collusion between the purchasing agent and vendors. Other things you would see is that companies will have pre-approved vendors, so that you can only purchase goods from vendors approved by the company. The receiving department is going to be responsible for ensuring that they're receiving only goods that have been properly authorized, meaning that there's been a purchase order associated with those goods. So they don't accept goods if they should not. The controls be if there's not a related purchasing order. The invoice processing is the processing of vendor invoices, and you want to make sure that you're only processing invoices for goods that have been received, so that there's an approved receiving report associated with that. And disbursements would be processing of the payments to vendors. Here's where you would want to see a three-way match. And the three-way match would be that there's an approved purchase order, an approved receipt of goods or receiving report, and a vendor invoice, right, before payment to vendor is processed. Then accounts payable and general ledger would represent the recording of those transactions in the appropriate journals and the appropriate accounts in the general ledger. Key functions and duties within this cycle would be related, obviously, to disbursements, the receipt of goods, and the ordering of goods. So you'd want to see typical segregation of duties. So, for example, the purchasing function should be segregated from the requisitioning and receiving function, right? Because if you don't separate those functions, you create the possibility that one individual is now responsible for requisitioning goods, placing the purchase, and receiving the goods, so they can have a fictitious purchase be made, right? And then they can possibly steal the goods, right? Because they have these three functions. The invoice processing function should be segregated from the accounts payable function. If one individual is responsible for the invoice processing and accounts payable, they could commit errors, or transactions can be processed at the wrong price, or cash disbursements can be processed for goods not received, which in a sense is best, right? It's a misappropriation of assets because you now have cash out the door and you didn't receive goods for it. Then disbursement function should be segregated from the accounts payable function. So if you have an individual responsible for both of these functions, they have the ability to make unauthorized payments that would be supported by fictitious documents. They can record unauthorized transactions, and again, it results in a misappropriation of assets via theft of cash. The accounts payable function should be segregated from the general ledger function, and again, this is if one individual have both of these functions, they can conceal any theft, which would normally be detected, because remember, one of our control procedures is that you reconcile the subsidiary records with the general ledger, and that would be the way that you would catch any discrepancies between those two. But if a person has both these functions or access to both these records, then they're able to hide that, any errors or irregularities. Same approach that we talked about in terms of the audit approach is, as always, we identify what the client's business risk is, right? Set the tolerable misstatement and assess inherent risk, right? Because and assess control risk. And so inherent risk, control risk is the risk of what? When we say inherent risk plus control risk equals the risk of what? Material misstatement, right? Good. Design and perform tests of controls and substantive tests of transactions, right? And we saw we just did that, so this is where our sampling procedures would be done here, right? In terms of what items we're going to sample, design and perform analytical procedures, and design, test the detailed balances, right? So during the testing phase, you don't have to perform analytical procedures, but they are an option depending on how the auditor assesses control risk or the risk of material misstatement. Inherent risk assessment specifically related to, because control risk assessment obviously is going to be the functioning of your internal controls or how effective your internal controls are. But industry-related factors would be, is the supply of raw materials adequate? So if you're a manufacturer, this becomes important. Why? Why would we consider this an inherent risk factor? The supply of raw materials, whether or not it's adequate, if we're talking about acquisition. I'm sorry? I didn't hear the last part. Right, so there could be a problem with the supplies, and how does that translate into the financial statement impact? Right, and so that's a financial statement error. But in terms of what inherent risk is, so let me try to give you an example of what happens if there was one problem that we did earlier in the semester where the company switched their strategy from a lot of tiny customers to much larger customers. And what did we say was the impact to the company of that change in strategy? What would be the impact of change in strategy? If you once had a lot of small customers and now you have a handful of really large customers. So most of your sales is generated by 5 customers compared to 50. Why would having 5 customers create a lot of errors? Because the number of customers is not what creates the errors, right? It's your controls. But now, so I'm the same size as a company. I just changed my strategy in terms of the number of customers I'm dealing with. So my controls don't change necessarily, right? I'm still the same company. I'm just dealing with a lot less customers but I'm generating the same or even more sales. What's my risk? What's my inherent risk? Right. And if one of the customers defaults in payment, underpayment, or they go bankrupt, and I have 50 customers, but if I have 50 customers, right, it possibly would not make that much of an impact, assuming that my sales and revenue is spread out amongst those 50 customers. But now, if I have 5 customers and one of those customers go bankrupt, that's your inherent risk, right? So your inherent risk increases because of this strategy change, right? But the flip side of that could be the risk, because now because I think in the earlier case, what we talked, the strategy change was now they're dealing with customers like Walmart and Target. So those customers are a lot more stable. Haven't heard that Walmart's about to go out of business anytime soon. So you have to weigh that. Well, now I'm dealing with fewer customers, but these are financially more sound, and the likelihood of them going bankrupt is probably a lot lower than if I'm dealing with 50 small customers. But my risk is increased because if I lose one of those customers, I've lost a substantial amount of revenue. So that's inherent risk. for the revenue. That applies here. If you're dealing, who's supplying your raw materials? It's just the flip side now. If I'm a manufacturing company and I can get a very important raw material from one of 10 companies versus I rely on one company to provide me with that raw material, what happens to my inherent risk? Right, my inherent risk is increased, right? Because I have one company that I can rely on. What happens if that company is in a part of the country where there's tornadoes or floods and they shut down and I can't get my goods? So if I can't get a critical raw material in my manufacturing process, it slows me down. I can't fill production. I can't complete production or produce at the level that I need to meet the needs of my customers. And if I can't meet demand, I lose business. It impacts my sales. So you see that so one cycle has an impact on any number of cycles. And so when you consider inherent risk at that very beginning time, when you're looking at the planning process and understanding the client's business, you're going to look at how that risk cycles through and impacts the company, not just for that one particular cycle you're looking at, but for all of the major cycles in the company. So that would be an example of how, the supply of raw materials, the adequacy of the supply of raw materials is important to consider in your inherent risk assessment, or how volatile are raw material prices, right? Because that's going to impact what? What you pay for inventory impacts what?
Cost of the product.
Right. And if you're in a situation where you can't pass that increase in price onto your customer in the sense that you could raise sales prices, it's going to impact your bottom line. Or if you try to pass it on and the customer will say, whoa, I'm not buying that from you, it's going to impact your bottom line. So these are the kinds of things, so at least how these types of things would impact your inherent risk assessment related to the acquisition cycle. Understanding internal controls, same approach. Speaking to the client, performing walkthroughs, studying the client's flow charts. So you're trying to get an understanding of the client, how internal controls, the internal control environment operates, and also performing, using internal control questionnaires. So all of the steps that we saw previously, again, we would apply those, but we're looking at internal controls over acquisitions and disbursements. Same thing, assessing your plant control risk. What's the authorization of purchases? What are the controls regarding the authorization of purchases? Do they have, for example, competitive bidding? Right? Are all departments able to issue purchase order, or is purchasing centralized? Can purchases be made from one vendor, pre-approved vendors, or anybody who's willing to sell us goods? So you're going to look at those types of things to assess control risk. Obviously, always concerned about segregation of duties, timely recording and independent review of transactions. If you remember when you did your Pinnacle case and you did part 3, I think, we was dealing with internal controls, this was one of the control strengths, right? That there was the processing of transactions were done on a timely basis. Who authorizes payment? And is that authorization, when we consider segregation of duties, is it appropriate? Determine the extent of testing of controls. So now we've assessed internal controls. Now we're going to test them, right? The auditor, again, is going to identify what the key internal controls are for the acquisition and payment cycle, and then determine whether or not there are any weaknesses in those key controls. And the way to do that is to perform testing of internal controls to ensure that they're operating effectively. So the internal control risk assessment, we talked about this when we were talking about sampling, when we talked about revenue, is your internal controls, your internal control risk assessment, right, is going to impact the amount of testing that you do in terms of your transaction, your substantive test of transactions. So when you find that your test and controls support your preliminary control risk assessment, then you don't have to make any modifications, right? So if you think back to the audit risk model, we said that inherent risk and control risk are related to detection, right? And the amount of evidence. So, for example, if we assess internal control risk as high, then we're going to want to look at a lot more evidence, right? We're going to say, we really can't rely that much on internal controls, so we're going to have to gather a lot more evidence. So whatever our assessment is, once we tested internal controls, and if it meets our assessment, then we don't have to make any modifications. And then the auditor can proceed with substantive testing as planned. And so again, if internal controls are effective and our testing reveals that it's effective, that can impact the amount of substantive testing that the auditor needs to perform. So some of the controls that are important in this cycle would be, so let's look at, again, we go back to the assertions. And so the first assertion is occurrence, right? So all purchases and cash disbursements have been recorded and they have occurred. So they're valid, essentially. That's what we're saying. That for the transactions that have been reflected, the disbursements, the acquisitions, that they're valid transactions. So the auditor could observe, they would observe and evaluate segregation of duties. We always want to look at segregation of duties. Test the sample of vouchers. We could use our sampling, statistical, non-statistical sampling, to select vouchers, which would be our sampling unit, for the presence of an unauthorized purchase order and receiving report. Examine those paid vouchers and supporting documentation for indication if they've been canceled. So if you remember when you did your Pinnacle, these are some of the control procedures that you identified as being control strengths, right? Key controls, and they were there. Reconcile and review vendor statements and monthly bank reconciliations. Then we test for completeness. Right? All purchases and cash disbursements that should have been recorded have been recorded. Some tests you could look for is numerical sequence of purchase orders, receiving reports, and vouchers. Take a sample of receiving reports, right? Because receiving reports are what triggers a liability, recognition of a liability. So this is going to be your sampling unit. So trace the sample of receiving reports back to the vendor invoices. And vouchers. Trace a sample of vouchers to the purchase journal. Account for the numerical sequence of checks. So those would be some things. Then authorization. So you want to make sure that all cash disbursements and purchases are properly authorized. Look at the purchase requisitions or purchase orders to ensure they meet the company's requirements for approval. And then I talked about review the client's bidding, competitive bidding practice. So a company with competitive bidding typically will say that before we accept ordered goods, we have to have 3 competitive bids. Basically, you go out to 3 vendors and you ask them to give you a quote on what the price would be to purchase those goods, and then based on the company's guidelines in terms of price and quality and the ability to provide the goods, you would accept the best bid from that vendor. And so this is kind of done also to ensure that you don't have collusion among, or to try to mitigate, I should say, collusion between purchasing agents and vendors. And so to ensure that the purchases and disbursements are being made in accordance with the company's guidelines and in the company's best interest. Other assertions, again, accuracy, cutoff, classification, the same assertions that we talked about previously. So for accuracy, you basically want to make sure that the vendor's invoice, for example, is correct, right? So you don't want to rely that the vendor sent you an invoice and everything on that invoice is correct. Right, that they cross-footed, unit price times number of units, and this is what they charge you. You want to see that the client is doing that on a periodic basis to ensure that the vendor invoice is correct. Agreeing information in terms of product, quantity, and price. So that would be some examples of the test of accuracy. Cutoff, same as we look at cutoff for the revenue process, you look at the shipping documents. Here you're going to look at receiving reports, right? Again, because they trigger the recognition of a liability, and look at the dates and compare those on the relevant vouchers. Compare the dates with the voucher dates, make sure that they recorded in the purchase journal in the correct period. And then classification is looking at the purchasing journal, the general ledger. You're testing those for reasonableness and making sure that they've been properly classified. So those would be tested transactions, right? So those are transactions related to purchases and cash disbursements. You also have balance sheet accounts, in this case liability accounts. Particularly the bigger accounts are going to be accounts payable and accrued expenses. So the assertions regarding test of balances would be existence, rights and obligations, completeness, valuation, and allocation. So for example, existence, accounts payable and accrued expenses are valid liabilities. You don't normally see that they confirm accounts payable, but it can be confirmed. That is an audit procedure available to auditors to perform. Unlike accounts receivable, where the standard requires you to perform confirmations for accounts receivable unless the auditor has a compelling reason not to, that's not the same standard for accounts payable. So an auditor is going to basically look at documentation. You could look at subsequent cash payments, disbursements. You could look at vendor invoices to determine the validity of accounts payable, or receiving reports to see when items were received or when a service was performed, to tie back to accounts payable. Accrued expense would be something like accrued payroll, right? So you could look at, gather information from payroll to determine the amount of work that was done that still remains unpaid for your employees as of 12/31. Rights and obligations, obviously what you're looking forward to is ensure that it's not a related party transaction, that is for third parties. The other thing that you also do is completeness. That's important, where you do a search for unreported liabilities. So you perform procedures here, because remember, with completeness, what you're concerned with is ensuring that all valid transactions have been reflected in the financial statements or the books and records. So that's why you would do a search for unrecorded liabilities, where you would look at, and you can do that in conjunction with doing your cutoff, to determine, looking at receiving reports after year end to ensure that that all items that before year end and after year end, to ensure that there are no items that were received but not recorded in the current period. And then valuation and allocation is similar, that is recorded at the correct amount in the financial statements. And then finally, you have your assertions about presentation and disclosure, occurrence, rights and obligations, completeness, classification and understandability, and then accuracy and valuation. So you want to make sure that all disclosures are appropriate, that accounts, they're presented in the financial statements in the correct. So for example, presentation with respect to debt, for example, is that you have to show long-term debt and short-term debt, and so you have to reclassify the portion of your debt that is due in the next 12 months from long-term to short-term, so that that's proper. Any disclosures about liabilities, such as pension liabilities or accrued liabilities, are properly reflected. Or any disclosures about litigation, for example, is properly reflected in the financial statements or notes to the financial statements. With respect to different types of analytical procedures that you would perform related to these accounts, would be looking at turnover, and looking at that as it compares to the previous years and as it compares to industry data. What your concern is with liabilities is that there's an understatement of liabilities. You're less concerned about overstatement because it's rare that a company is going to overstate liabilities, right? Because if they've overstated liabilities, right, then that means that they've understated income. And most companies are not trying to understate income. All right, there are some exceptions where a company might be trying to smooth earnings. So they are, you know, for example, they might be having a great year, but they want to manage expectations of the market. So they might set up some reserves, and that's a way of we call them a big bath kind of reserves, so that they set the reserves up now and they can use it later to take it down. I think we saw this. Remember when we did the negotiation case where you had to talk with one side was the auditor perspective and one side was the client perspective, and the client had been, you know, building up their allowance for doubtful accounts, and so now they wanted to take it down. Yes.
Well, what companies do that? Is it to like surprise the market?
To manage market expectations. So say, for example, because the market fixates on earnings, right? So what if some reason if a company, because management knows, they know their business better than anybody. And so if, let's say, they're like really piling up, they're doing really well for some reason, really well, but they know that they're not going to sustain that. Let's say you know that, look, we know that a competitor is going to come out with a better product, or we heard, so our income is going to take a hit. You know, we're not going to be able to sustain this growth. We don't want management, we don't want the market to think that this is, you know, forever. So what they do is try to manage it so that it's like, okay, if we forecasted, you know, I don't know, net a 5% growth this year, but we really look like we're going to double that growth. We don't want them to think that we're going to always be able to double, that we're going to always be able to grow at 10%, because they're going to expect that. And so what will happen when we don't grow at 10%, they're going to ding us. So let's pull some of this back, and we know we're about to go, we could hit a down cycle. We'll just reverse the reserves later on.
Possibly we could like benefit the company by, if you hold it and when the earning comes out, the stock price will go up.
Right, if you hold it back, because the market doesn't penalize. If you meet expectations, they don't penalize you. Even, and I don't. This is not my area of research, but I mean, the market is like, if you say you're going to do 10% and you do 10%, great. If you say you're going to do 10% and you do 5%, not so good. And if you do 15%, then wow, we want to see, then why aren't you going to do 15% next year and the following year and the following year? So companies might try to, that's what they call income smoothing. You know, like they try to manage the market's expectations because they don't want to see it reflected in their stock price.
Also other things, like the management, they have like a cap for their compensation. So for example, if they meet that cap, anything additional they gain, like anything additional the benefits, they are not going to get anything out of that.
Right.
So they prefer to leave it for next year, for the following year, where they would actually get something out of it.
Right. So it's like, why use up all of my goodwill now? Right. Let me spread that goodwill over. Right. Right. So, and this is like that when Arthur Levitt was the chairman, this is what he talked about a lot, that it was earnings management is not only that companies try to manipulate earnings to increase it, but they also try to manage earnings to manage market expectations. And so if they're managed, so this is what he termed the big bath reserve. So if I set up these reserves today, and then, you know, over the next couple of years, if I'm not doing as well and I see that I'm not going to meet market expectations, I can reverse the reserves. Because what are these reserves? They're estimates. If you think about, again, the case that we did, inventory obsolescence is an estimate, right? The allowance for doubtful accounts is an estimate. The client came at it one way and the auditor's side came at it another way. So where do you settle on, right? So it has an impact. But that's usually if they have those, if they overstate liabilities intentionally, it's usually because they're trying to manage earnings. Other things would be comparing last year to prior year, looking at amounts owed to individual vendors, looking at purchase returns as a percentage of sales. So these would just be the different types of analytical procedures you perform. But again, with analytical procedures, it's very important for auditors to have a really good understanding of the client so that they set the right expectations in terms of evaluating the outcomes again. Some tests of detailed balances to test accuracy, obtain a listing of accounts payable, foot it, agree it to the general ledger, look at vendor vouchers and vendor accounts, and then tie that back to supporting documentation and verify the accuracy of the details. Completeness, conduct a search for unrecorded liability, as I pointed out before. Ask management about their control procedures, get copies of the vendor's monthly statements and reconcile that back to what's recorded in the client's financial records. Confirm vendor balances. As I said, confirmation is not required, but it's certainly an audit procedure available to the auditor. Vouch large dollar items from the purchase journal and the cash disbursements journal for a limited period after year end, because again, what you're trying to do is see if there are any liabilities that should be recorded that haven't been recorded. Look at, and this is a really big one, unmatched purchase orders, receiving reports, and vendor invoices for any unrecorded liabilities, because, you know, especially around year end, and especially if you're a manufacturer, what you find there's a lot of activity around year end, and so the chances for things to be backlogged are increased, and so that's why you would want to look at any open files. Balances and disclosure existence, again, looking at accounts payable, to supporting documentation, doing a cutoff test, so you would look at transactions to ensure that they're recorded in the proper period. Rights and obligations are basically that you're recording liabilities that are the company's liabilities and not a liability for employees or senior management. Valuation, that the amounts are recorded obviously at the correct amount, and then the classification obviously would deal with how they're classified in the financial statement. I talked about disclosures. So for example, payables, you want to make sure that accounts payable, it reflects trade accounts payable, so accounts payable due to vendors, that it doesn't include accounts payable due to employees. That is anything due to employees, you'll see, you know, a separate payable. You might see that in accrued expenses, for example, or if it's large enough, it would be classified on the balance sheet as such. I already talked about the classification of short and long-term debt and payables, long-term purchase contracts. Those types of things would be important to a user to know about any long-term purchase contracts or any unusual purchase commitments the company has. So you would expect to see these disclosed in the footnotes to the financial statements. For example, if they're dependent on a single vendor or a small number of vendors, those kinds of things, again, would impact someone's assessment of the company, and so they should be disclosed. That's it. Any questions? I know I went through this quickly, but most of this we've covered in terms of the audit approach. So again, just to kind of highlight, the same approach. Risk assessment is just identifying what the inherent risk is related to this cycle, the control risk, and then performing the audit approach as we discussed earlier. Okay. Any questions? All right, before you go, one thing is I need to, the other class asked about a review session. So what I'm going to do as we get a little bit closer to, probably next week, send out email, and I'd appreciate it if everyone responds to the email to let me know if you're interested in a review session, and then also what dates and times, you know, are available, because I'd like to try to get one big review session if possible. Okay. If you're not interested, that's fine. You don't need to email me. But if you are interested in a review session, please email me that information. The other thing that I will stress to you, if you're not sure you're going to be able to make it, don't sign up for it. Just make an appointment to come and see me and ask questions that you need to follow up on. Because I do not want to be put in a situation where I schedule it in a review session and it's me and 2 other people, because I can need 2 other people in my office. Okay. So it'll be non-class times. That's why I need to schedule. Oh no. I like you a lot, but I love my weekends. No, it could be possibly in the evening. If let me know. But just shoot me some more. Just give me more than one option, and so I'll try to get the date and time that works best for everyone. If I can't do both classes together, then I'll just schedule one for each class. Okay, good. All right, enjoy the weekend. I will see you next week. Don't forget, the quiz is due, I think, Monday morning or something, or Monday evening.